So you want to get in on the GameStop trade, but either your broker's not letting you buy shares, or you just looked overnight and you saw the price go from a closing price of $225 down to $150 pre-market. You're getting cold feet. But what if I could show you a way that you could not only support your fellow retail trader with some long demand, but also to do so in a way that's very conservative, maybe earning about 6% on your capital over the next 6 weeks? Would you be interested in that? Hi, I'm Doc Severson for the ReadySetTrade Trade of the Day for Tuesday, the 2nd of February. Now, I did hesitate before doing this video because there is so much passion out there around GameStop, and it's almost gotten to be religious or tribalistic, where people are seeing what they want to believe in the markets, which is a type of confirmation bias that we all have. And this is why human beings are funny, because we all see what we want to see and not necessarily what's actually happening. So I come at this as a sort of disinterested investor saying, hey, there's an opportunity here, and I would like to take advantage of it. Now, at the same time, I will take sides if it comes down to it, because I think what the hedge funds have been doing for decades is nothing short of criminal. So I love this David versus Goliath battle, and I love to see David stick it to the man. So in this case, what can we do to support that battle while also putting ourselves in a position to make money and not become a sacrifice on the altar of retail trading? First of all, there's a concept in trading which is called reversion to the mean. When things tend to get a little bit stretched, that rubber band stretches, it tends to revert back to the mean. And this happens not only with price, but also with volatility. And what I'm looking at here is implied and realized volatility, with implied being the blue line. And right now, implied volatility is super sky high. And so really, this is the basis for the edge in the trade. It's not necessarily the price. Now, what I've added are the Bollinger Bands to the price. You can see the price has got way above the Bollinger Bands and now is being pulled back inside. If we go to a smaller sample of what's going on here and kind of drag this back, you can see how the price has been pretty much trading around these bands, with the center moving average being sort of the mean at the time. Now, again, just looking at the price, I don't know whether the price is going to come all the way back down and revert to former price levels, or whether it's going to take a bounce and go higher. Don't know that. Or it could bounce into what becomes a lower high and then roll over again. I honestly don't know what's going to happen to the price, but I will say that in my case, I'm looking for volatility to revert back to the mean. And so if we go back and look at this, what is the mean? Well, the mean is somewhere down in this area, somewhere between, say, like $10 to $20 a share. This is where the price was before things got really out of hand to the upside. So I would expect at some point in its life for the price to come back down to there and use that as a support level. Now I'm going to pull up the option chain of GameStop, and I'm going to go out to the 19 March, which is 45 days out, which is a nice time frame to work with. And we can see that the current price right now closed yesterday at 225, and right now pre-market is actually below 150. As I've been talking here, it's down 141, 142. So what we're going to find is that these option values, when the market does open, when that opening bell rings, are going to actually be much richer than this. So would it be too conservative to say that I would be willing to buy GameStop if the price came down to 10 or lower? Yes, I would be. And I want to get paid for that. So if I sell the $10 put for 19 March, I'm going to get paid approximately, and these are yesterday's numbers. When the market opens up, it's going to be much richer than this. More than likely, it's going to be almost $1 by the time the market opens up. But let's just work with today's numbers as we know them right now. So if I'm going to receive $65 for selling the $10 put, I'm going to have to put up for every contract, I'm going to have to put up $1,000 of my capital for that. And so we find that that's a 6.5% return right off the bat. Now, again, I think I'll be able to do better than that when the market opens up because it should be higher than 65 cents. It might be as much as $1 by the time the market opens up. Let's go back to the chart and show you how this trade works for the different outcomes of the price. Okay, so let's just say the price is around 150 right now. If the price ends up going higher into March, then my puts will expire. I get to keep that $65 per contract, and I have to do nothing to do that. I get paid that from day one. If the price goes sideways into March expiration, I keep that $65, and my obligation expires on March expiry. Even if the price goes down to like $20 per share by March expiration, my options will expire and my obligation is released upon expiry. It's only if the price comes down to or below that $10 per share level that I'm going to be on the hook to buy GameStop at $10 a share. However, I'm going to get that credit that comes in of 65 cents or maybe as much as $1 today. So my cost basis is going to be somewhere in the $9 range. Now, I talked about being able to support my fellow traders. How can we do something like that? Okay, if I am selling the $10 put to open the position, somebody has to buy that from me. So if I sell that $10 put, the market maker has to buy that from me over on the other side of the ledger. So if they're going to be buying that $10 put, they're not going to hold that $10 put naked. What they will do is they will add stock. So they will add GME stock to hedge that position. And so right off the bat, I become an indirect sponsor of GME demand by selling the $10 puts. And as we all know by now, more demand causes short liquidation if it overwhelms the short supply. Now, just a footnote here, I sold puts on AMC yesterday. I was unable to do so through TD Ameritrade. They would not allow me to open that trade. I had to go over to E-Trade, and some customers have said that they were able to open those trades on Fidelity as well. So I expect the same thing today. I'll try this on TD Ameritrade, but more than likely we'll have to move over to E-Trade and see who allows me to sell those $10 puts. The problem is that they don't want to add demand. They don't want to take the other side of my trade because they understand what I'm doing. So there it is. If you like this trade idea, consider joining our 10X tribe for free at elite.readyset.trade. Thanks for listening. We'll see you in the next one.